Okay, guys, we are live on stream in 5, 4, 3, 2, 1.
All right, welcome everyone. Thank you so much for attending this first session. Really excited to be speaking to you all today and to be speaking to our guest joining us for this session, Demi. Really quickly, as an introduction, my name is Seven. I am the startup and VC lead here at Color in Tech. So I'm really excited to be speaking to Demi today, who's going to talk to us about alternative funding for entrepreneurs, founders, and small businesses. Demi, how are you, man?
Yeah, not bad. Thanks again for having me, Seven, and to the whole Black Tech Fest team. Yeah, looking forward to these next few days and yeah, just kind of meeting loads of cool founders.
Amazing. Well, thank you so much for being here. We're happy to have you. And I'm really interested in learning more about this topic myself. So this is going to be a fun one. Let's start off with learning a little bit more about you. If you could tell us briefly about your experiences, your expertise, and what your company Lendoe does.
Cool. So in regards to like my experiences, I've kind of always been involved in the financial markets, always been interested anyway from a young age. When I was in college, we went through the last recession. So my economics teacher just kind of really kind of got me involved in reading headlines and seeing what was happening in the markets. But I think, I really got involved in corporate finance and alternative funding when I started working for Obsidian, which was an investment banking boutique that focused on raising capital for corporates in emerging Africa. And those are typically, medium to large size corporates. And that's when I met the world of, I found out about venture capital, private equity, alternative financing, debt, different debt structures from senior secured to mezzanine finance. And then after that, I went to work at a place called, I took a short break actually, done some consulting for a while in America and Nigeria. And then I went to work at a place called Zopa, which was the world's first peer-to-peer lender. And that kind of introduced me to fintech. And, at the time I was actually only working part-time, but because it was a small, very fast growing company, effectively a startup, I got exposed to kind of like all of the different moving parts, capital markets, how we raise capital, alternative financing from large corporations, buy-side corporations, and how we deploy that capital to individuals. So we was at Zopa providing funding to underserved individuals who are unable to access normally bank financing. And then after Zopa, during Zopa actually, I came up with the idea for Lendoe. And yeah, after Zopa, I decided to kind of take Lendoe full time, and try and go for it. So that's a bit about me and my experience. Definitely corporate finance / alternative financing. And in regards to Lendoe and what we do, effectively, we're an alternative finance platform, particularly focused on providing capital for underestimated entrepreneurs. And when I say underestimated entrepreneurs, I'm typically talking about entrepreneurs that the banks, not that the banks don't want to fund, because what we've found over the years actually is that now that banks are realizing that this is a growing market that we're serving, they actually want to fund them. But what the problem is because they've underestimated them for so long, a lot of these founders now don't actually want to even work with the banks. So they work with companies like ours to access things like venture debt, corporate finance, alternative financing, and effectively, different ways and methods to finance their runway that they can't on the high street.
Nice. So the short version is you really know your stuff, which is an amazing thing to hear. And it's why I think this is going to be such an interesting conversation. So we're going to talk about what that alternative finance is and what it means and looks like in a minute. But the first thing I want to actually touch on is the more traditional space that entrepreneurs will usually raise money in, which is with VC funding or something similar. So obviously, and you kind of alluded to this, right now is a difficult time for some founders looking for that traditional investment, VC funding, whatever it is. Why do you think that this is the way the market looks right now? Why is that changing, and how long do you think this will last?
Yeah, no, it's a really good question, sir. It's an interesting one because it's how long is a piece of string, right? No one's really too sure at the moment because of the fact that there's so many kind of like macro issues that we're facing at the moment, right? We've got the war in Ukraine, we've got kind of inflation across across the globe at the moment, right? We've got interest rates rising in the, some in the two biggest economies, which is the US and the UK. And we're seeing rates kind of go to levels that we haven't seen in the past 6, 7 years, if not longer than that, maybe the past 10 years. So I think there's a number of reasons why it's really difficult to raise traditional funding at the moment. But I think rates rising is definitely rising, and the war in Ukraine, which of course is a kind of affecting consumer consumer confidence, is probably the two biggest reasons. I think from a VC perspective, right, and LPs, limited partners, kind of maybe taking away cash from a lot of the VCs, or the VCs not being able to deploy as quickly and as fast as they was previously. I think it's just because no one's really too sure what's happening at the moment. And where a VC might have previously said, okay, I'm going to invest in this company, and based on how hot the market is, based on rates being low and money being very cheap, it's highly likely that this company is going to raise again and eventually get to IPO. Now with rates rising and money not being as cheap as it once was, money's not as easy to come by. So it's a bit harder to make the returns that VCs used to make when money was cheap. Now in this current climate, and also when you think about it from like a investment standpoint, right, from a limited partner perspective, they now have other options where they can get a really safe, strong return because of the fact that the US are rising rates, the UK is rising rates. So things like bonds are becoming very attractive again, and you're just basically seeing what I believe to be an asset, a kind of like a re-asset allocation, shall I say? People allocating assets and allocating capital into new assets where they feel like, look, I can get a better return here, or I can get a more safe return. And in times of uncertainty, as you know, right, cash is always king. So I think that's one of the key reasons why you're seeing it's becoming quite difficult to raise from traditional places like venture capitalists and even banks to some degree, because these institutions are saying, well, can we put our capital in other places where we'll get a safer return?
Yeah, I'm with you. So essentially, entrepreneurs are generally a riskier bet, right? And so if you can't turn to those VCs, even if they're traditional funding, or maybe you're less likely to raise from them, you need these alternatives that we've been kind of alluding to and that you guys support with. So talk to us now a little bit about what we mean when we say alternative fundraising, right? What are those options? What does it mean? What does it look like? And really crucially, when is it most viable? When is this an option entrepreneurs should go, yep, that's where I'm going to get my funding from, not VCs?
Yeah, no, it's a really good question, because when you look at like the business life cycle, right, you can find different alternative options at different stages of that life cycle. So there's never really a particular time when I would say go for alternatives, but I definitely always tell entrepreneurs, look at the traditionals, look at the main high street banks, look at the VCs, but also look at the alternatives, because there's always another option. And when I say alternative, I'm talking about everything from venture debt, which you can set at the very top end next to VCs or next to founders that are raising, Series B, Series C, Series D. I mean, we're seeing a lot of founders at that Series A and Series B stage now saying, you know what, we can't get the capital we need from a VC, or if we can, it's at a valuation that we're not happy with. So we're going to look at, potentially raising some venture debt, which is effectively similar to venture capital, but it's a debt product that's structured for fast-growing venture backable businesses. And you find providers out there like CapChase, who have recently raised, I think, £400 million fundraise. You find different providers out there like now Outfund. You find different providers out there such as Clareco. These are all providers that can provide you venture debt financing, and they can provide it to late stage entrepreneurs, even some that plan to go on IPO and plan to use venture debt as a way to not dilute themselves any more than they already have. But at the same time, you also have alternative financing options at the very start of your business career, right? So that might be pre-seed, that might be seed. If you've got a really strong set of VCs that have backed you at pre-seed, and you're realizing that, I want to extend my runway a little bit, because again, valuations are not the greatest at the moment. And I'm thinking about maybe testing my product in the market, getting my MVP out there, getting some validation to improve my valuation when I do raise. And you can sometimes go and raise some venture debt off the back of that. It won't be the same structure as it would be for a late stage entrepreneur or an entrepreneur at a different stage of their business journey. But there are products out there, the likes of the SVB can provide you venture debt financing up to about starting at about £1 million. And sometimes that's solely based off the back of the strength of your VCs rather than actually your cash flow and the likelihood of you raising another round. And then, when you take a step back from looking at venture debt, there are other options like stock financing. You're finding a lot of great e-commerce businesses that are growing really fast and have been since the breakout of the pandemic, that are taking advantage of stock financing because, you look at the economy at the moment, supply chains are, unfortunately, no one knows when the goods are coming. There's a war in Ukraine, so cost of shipping is sky high, but you've still got great opportunities like Black Friday, like Cyber Monday to sell your products. If you're going to kind of use your financing from your cash flow, it can be very tight and become quite difficult. So a lot of entrepreneurs are going out there and they're using stock financing to finance their stock, to know that, okay, we've got enough money we've got enough stock on hand. We can use our money to focus on marketing and doing the things that we need to do on the ground. So there are all types of, alternative finance products, but we like to specialize in venture debt and stock financing and products that really suit, today's modern day entrepreneur.
Yeah, I get you. Thank you for such a detailed breakdown. Obviously, when you take anyone else's money, right? Whenever a founder is taking someone else's money, whether it's from VCs and the institutions, or it's venture debt like you described, and any of the other alternative options, you're taking someone else's money. And so there are going to be risks there and there are going to be things to manage. There's a lot of pressure when you take other people's money. I think a lot of us, when we look at loans from the banks, we go, well, what if I can't pay it back? Will they take my house away? So there's this question in here, which I'd love to throw to you, which is, what are the risks of taking these alternative funding options, right? When should our audience who's watching today, founders in general, underrepresented founders specifically, when should people not be considering these options?
So, what I always advise entrepreneurs and founders is when you're not very clear about your business model and your unit economics, then you shouldn't be considering any of these options, I would say, right? Or when you're not clear about, okay, exactly how am I using this capital to get to the next stage of my business? If you're, let's say, a startup, then I don't think you should be taking this capital. I think, equity and family and friend money is a lot better suited at that earlier stage of your career or your business journey where you're not really too sure. Now, don't get me wrong, there are certain businesses, like I mentioned, that are e-commerce businesses. They came out of the pandemic flying. They very quickly understood their unit economics, but they had the support of things like Amazon, FB&A, like all of these different infrastructure products around them to help them quickly scale up so they can understand their unit economics. Or they might have had a Shopify account, which kind of breaks down your customer acquisition cost and so on and so forth. All of those things can help you understand that, all right, I now want to take capital. But until you really understand your unit economics, I don't think taking capital is a smart thing to do because of, like you mentioned, those risks, right? Whether it's whether it's equity or debt, right? That could be venture debt, that could be venture capital, that could be stock financing, that could be a credit line. There is always an element of payback. Now, if it's equity, it's an element of we're investors and we expect you to make a return. If you don't make that return, we may have to either replace you as CEO, or sometimes in the worst case, and we're seeing it's happening a lot at the moment, we may have to liquidate the company for us to make our return for our investors because they need to make a return, right? And you're seeing that happening to quite a few businesses now, unfortunately, right? But if it's debt, it may be a case of you might have to sign a personal guarantee, which means, yes, if you sign a personal guarantee, your home may be on the line. But I think what's really interesting about venture debt, which sits in the middle of just debt and venture capital, is it rarely requires you to sign a personal guarantee. And it usually always focuses on the business itself, similar to the equity side. When I say focus on the business, on the performance of that business. And what these lenders and these funders are betting against is based on you understanding your unit economics, based on you performing to a certain degree over a certain amount of time, usually 5 months or more. We're confident that if we give you this capital, we can effectively get a return on our capital, but we can also allow your business to grow. And I think when you look at the risks of things like venture debt, stock financing, most of the alternative finance products, it's a good balance between equity and traditional senior secured debt that you would get from a bank or a startup loan provider. Yeah,
it sounds like it, because obviously with traditional venture capital, like you said, if things go really wrong, even if it's your business on paper, something can go wrong. Someone can kind of take that from you, and that can be a little scary.
Yeah.
So there are risks to balance, but they're different. Okay, makes sense. I'm with you. The next thing I want to speak to is why you got set up the way you did, why you set up Lendoe, and the purpose behind it, and kind of what it means for audiences like ours. So obviously, with the work you do, you're providing a kind of different service so that more people can kind of essentially access the business growth that you've described. What do you think these alternative options and access to them means for diverse entrepreneurs, or in your what your business focuses on more specifically, underestimated entrepreneurs?
I think for underestimated entrepreneurs in particular, it means opportunity. Because the way the alternative finance landscape works, it's often funded by private individuals. And what that means is that there are a number of alternative finance providers out there who no one will know about. And in fact, they don't want to be public. What they'd rather is a company like Lendoe, who can sift out all of the bad apples and only bring them the good apples. They'll rather work with a company like ours because it makes their job easier. It means that they could be a family office with maybe, I don't know, let's say a £500 million fund, but maybe 5 employees that don't have to think about creating an operational team, a call center, a marketing team. All they have to think about is working with Lendoe in order to provide financing opportunities where they can make a risk-adjusted return in order to make a good return for themselves. So I think when you look at kind of what it means for underestimated entrepreneurs, it definitely means opportunities, and particularly with what's happened since the pandemic. Because what you've seen is when the pandemic happened, you know, as a kind of a global community, we changed the way we consumed, we changed the way we behaved, we changed the way we learned, we changed the way we kind of related with people, we changed the way we networked, and what that created was a whole range of opportunities for new business models to be birthed. And all of those business models, unfortunately, when they at their inception wasn't understood by the banks initially, right? And they're still on really understood by the banks. But what's happened is a lot of other people who have capital, private capital, have seen that and have said, you know what, I can come up with a really creative solution to actually solve that need for that entrepreneur or for those type of entrepreneurs. So whether that be startups that are in the last mile delivery space that kind of really took off during the pandemic, or whether that be e-commerce businesses that are really early stage, but because they're maybe using Amazon to do marketing and to do warehousing, they've managed to scale significantly fast. There are businesses or kind of funders out there, alternative financiers, that have built products and solutions for them. So what it really means is that there's loads of opportunities now. And I think where underestimated entrepreneurs in particular tend to be from minority backgrounds, with these new products, these new funding products that have been created for this new modern day entrepreneur, what you find is that it looks a lot more at the data than it does at the person behind the company. Now, the person behind the company is always going to matter, right? Because they're the person driving the company. But there's a lot more emphasis on the data, and that data can be extracted through different online means, different digital footprints that can be extracted from the web. And I think that's the real opportunity that has been created by not only the pandemic, but also by these alternative finance providers that are taking advantage of effectively what's changed since the pandemic.
Yeah, and I think, just before we started, you were telling me a story of actually how you got started with Lendoe. I think that's actually a really beautiful example. If you want to share that with us really briefly.
Yeah, so the idea came about, way back in 2015, 16, and 17. It formed between those 2 years, because what happened was, we was raising capital or raising financing for a church who needed to attain a mortgage. It was actually my church. And what had happened is, a great example, they had gone from a charity to being a CIC, like Black Tech Fest, right? And what that meant was that they had to change limited entities because they was no longer underneath the charity commission. They was now going to be a social enterprise. But in making that decision, they couldn't take over their mortgage. So they had to pay off their mortgage as a charity, and then try to attain a mortgage as a CIC. But because this happened, they attained their mortgage prior to the recession, and they tried to attain a mortgage post-recession, banks weren't lending how they used to because of the recession, 2008, 2009. 2010 recession. So what it meant was that where they had a mortgage before, they couldn't get a mortgage again. And that wasn't because of the fact that they wasn't experienced, they didn't have a great asset that had a great loan to value. It was more because of the fact that there was an early stage business. And it comes back to my point of early stage businesses often being underestimated. They had a strong management team, the same management team that was managing the charity. They had a strong asset. They had a whole bunch of members, and they had a whole bunch of ways of generating revenue. But because of the fact that there was an early stage business, they were underestimated by the banks. And what ended up happening is, myself and several other young adults, we ended up financing the mortgage ourselves for 2 years, because our plan was, the banks had said to us, once you have 2 years worth of trading, you can come back and get a mortgage. So we said, okay, we'll finance it for 2 years and then we'll come back to you. So the banks were our exit plan. But when we realized between 2016 and 17 that actually the banks weren't going to, they weren't going to take this mortgage from us as a bunch of investors, we said, well, we've got to figure this out, and we've got to kind of find out where we can go and find out why banks are not lending to small businesses. And in doing that research, I came upon several facts. One was 50% of small businesses that applied for funding were rejected on their first time. Another was 60% of those that kind of are classified as would-be seekers. That's people that would be seeking financing if they felt they can get it. 60% of those people were often would-be seekers because of the things like the fear of rejection. And actually, if they applied in 2017 and 18, the level of small business lending would have increased by about 20% as a whole, right? That was about 15. That was about 3 billion, and the level of small business lending, I think at that time, was about 13 to 15 billion, 15 billion. So I mean, it's all of these facts made me realize that there's a big problem here, and actually, not only can we solve this problem for the church, but there might be others that we can solve this problem for. And we found that to be firsthand. When we financed the church, a lot of people started reaching out to us. A lot of people asked us for if we could finance them. Of course, we couldn't provide them nowhere near the level of financing we provided to the church, because that was most of the money we had, right? Disposable money we had. But what we could do is, instead of taking interest from the church, use that capital that the church was paying us to give them small 1,000, 2,000, 3,000 pound loans. And that's how Lendoe started. Literally, we started from the proceeds that we generated from the first loan.
Yeah, I get you. But change can be that simple, right? With just that kind of small amount. Sometimes that's all you need.
It's confidence.
Having options. Yeah, there you go. And having that confidence that you have options there is for some businesses going to be life changing. Cool. Thank you for that, Demi. I've got one final quick question I want to ask you before we're finished for this chat. So, you believe that now is the best time for founders to raise funding, despite the landscape that we're in, which sounds crazy to some people, but I'd love to know why you feel that way.
Yeah. So I have to put that into context. So I think now, I think now is the best time for underestimated founders to be raising financing. And the reason why I say that is because we all know, right? It's a fact that only 1% of VC capital goes to founders of Black and ethnic, founders of Black descent, right? I think it's only 3% of founders of ethnic descent. Now, because of that, there is a high level of rejection in the VC landscape. But those that are being rejected, there are an array of different options available to them now, because of what I mentioned earlier about different people noticing the opportunity to finance different types of new business models and setting up small boutiques, small alternative finance businesses, so they can get a return for themselves and maybe their family if they're a family office, or maybe their business if they're a relatively small business lender. And there's never been more funding options. I mean, don't get me wrong, things are hard out there at the moment, right? But what we've seen over the past 3 years is alternative financing go from taking 7% of the small business market to almost 20% of the small business market. And that's because the options are now there. And founders, entrepreneurs are realizing that, hold on, I can't get VC capital, and I'm not going to continue banging on the door that's not opening for me. I can't get bank financing. And you know what? I'm not going to continue knocking on the door that's not open for me. Where else are my options? And there's an array of options out there. There's everything from people that will buy your stock from you and then allow you to pay them back once you sell your stock, to venture debt providers that will do things like just give you funding based on the VCs that you've already invested from, based on their credibility rather than your credibility, all the way down to things such as it's like a new form of this B2B buy now, pay later, where your services, you can actually now, as a standard B2B service provider, offer credit to your customers. based on their credibility, not based on your credibility. So, you know, the invoice financing itself has been revolutionized. And these are just some of the options available to founders at this time. I think the problem, I mean, where there's a problem is founders, and maybe this is why Lendoe exists, right? Because founders don't know where to go, right? But there are places for them to go and access financing to kind of take their business to the next level. And those that are doing it, they're doing it at a rapid rate. I mean, we recently completed a fundraise for a fast-growing e-commerce brand who in year one done 1.5 million. In year two, it's looking like they're going to do 10 million by the end of year two. So far, they've done 7 million. And because they're so early stage, no bank will finance them. No bank would finance them. They managed to raise some funding from angel investors, but to get the capital they really need to get to that next level and hit that 10 million pound mark and beyond, and then potentially look at VC, they needed alternative financing. And we managed to raise them not only a credit line, but also some stock financing, so then they can manage their cash flow as you come up to things like Black Friday. So there are opportunities out there, I guess, if you have someone like Lendoe by your side who can kind of navigate you and kind of tell you where the opportunities are in the market.
It's so important to be talking about this, because I feel like we need a big list of all these options, and generally we know about like 1, 2, maybe 3 of them. Yeah.
And I mean, look, I'm more than happy to have a talk with Ashley and yourself about kind of, look, how can we collaborate? How can we let more people know about the options that are available to them? How can we talk about actual real life testimonials of fundraisers that we've done for, you know, fast growing businesses in this environment? You know, more than happy to do that. So we can
maybe it's something. It's definitely a list we should be putting together for all the founders that we support. So let's work on that. But I mean, I believe, if I'm not mistaken, that brings us up to time, or maybe even just slightly over time. So Demi, thank you so much for chatting with me today. It's been really, really interesting. I've learned a lot myself personally. So yeah, thank you so much. Where can people reach you, learn more about you?
So you can reach me on LinkedIn. My name is Demi Ariel. Alternatively, you can go to the Lendoe website, www.lendoe.com. Alternatively, you can reach me on socials, Twitter, Instagram, and that's Demi_VB_. I'm doing a whole bunch of events this Black History Month, so I'll be more than happy to connect with anyone at any event I'm going to, so I can kind of give you what events I'm going to be at. And I should also be at Black Tech Fest on the 13th as well. So yeah, we want to have to talk to anyone who wants to catch up then.
Great. Thank you so much, Demi. Appreciate you being here.
Yeah, no, thank you so much, Stefan. And like, it's been a pleasure, and I love what you and the team are doing. And I look forward to working in the future.
Thanks so much. All right, have a good one. I hope everyone enjoy it. See you later.
All right. Thanks, Stefan. Cheers, bye.
Bye.